India's economic growth likely accelerated to 7.3% in the July-September quarter of FY26, supported by a low base, stronger kharif activity, firmer rural demand and softer inflation, according to a Moneycontrol poll of 11 economists conducted last week. The projection is slightly above Reserve Bank of India's expected 7% growth for the July-September quarter. If the forecasts do hold, Q2 would be the third consecutive quarter where growth has held above 7%. On a full year basis, economists expect GDP to grow 6.9% in FY26, signaling that the momentum may moderate in the second half of the fiscal year. But even then, the forecasts are much above 6.5% projected earlier. The median inflation is projected to be 2.1% after October through a surprise low of 0.25% inflation. Welcome to Beyond Averages, our weekly data podcast where we try to break the numbers behind the big stories. This week, we are talking about the growth numbers to be released on November 28th. Economists highlighted that favorable statistical effects, especially the low 5.6% base in Q2 FY25, combined with better monsoon outcomes, rural demand recovery and pre-festive inventory build-up contributed to a stronger second quarter growth. We have with us Gaura Sengupta, Chief Economist, IDFC First Bank, and Rumki Majumdar, Economist, Deloitte, to discuss what lies ahead and, more important, what's holding back India's growth. Gaura, first question to you. Why are we expecting the high number in Q2 1? 2, can this hold in Q3 and Q4 as well?
I would say the Q2 GDP, the underlying high frequency trends are much more positive than Q1. Q1, though, the GDP was exceptional at 7.8, and we do expect it to go to 7.3 in Q2. But I would say that the breadth of the recovery is wider in Q2. For example, we are seeing broad-based pickup in rural consumption, which was very nascent in Q1. Now we are seeing it across indicators. You look at two-wheeler sales, you look at fertilizer sales. More importantly, if you look at labor market in the rural area, that is definitely showing signs of pickup. We have got consistent decline in employment demand under NREGA. If you just look at company commentary, on a consistent basis, they are reporting a much stronger pickup in the rural areas. Meanwhile, urban in Q2 is a bit softer. That remains a bit softer, but urban has responded to GST cuts, but that's a more Q3 story. The other one is a few transient factors which had supported Q1. They remain present in Q2. For example, your GDP deflator growth slows further. Our estimate is zero point 0.6 for Q2 from a zero point 0.9. So the real growth rates get a boost. And apart from that, you've got the exports to the US. Q1 had got support from front loading of exports to the US, but the support is a bit lesser in Q2. We do see a slowdown in export growth in Q2, but I would say the real decline that we are seeing in exports to US, that's again started off from September onwards, will be more pronounced in Q3. So the drag from the trade side is also softer. Plus, we are lucky that while our trade deficit is widening, services surplus has remained, I would say, substantial. So that has reduced the drag. And more importantly, if you look at listed company, I think what makes me a little more confident on growth from what we were before is if you look at listed company performance, the pickup or the continued growth in profit this time was not due to margins, which was a Q1 story. This time, we're actually seeing a pickup in net sales, which is a good sign. It shows demand is also domestic demand is recovering. So for us, I would say the breadth of the recovery is much wider in Q2 compared to what it was in Q1.
And Gaura, what about the second half of the year? Do you expect growth momentum to continue, or do you expect it to weaken like the RBI is expecting 6.4 and 6.2% going forward?
So we have also kept a very conservative estimate for H2. We are at, I think, a 6.5 for Q3 and a sub 6 for Q4, but I honestly will not be surprised if Q3 is also closer to 7. The reason being the one, yes, there is an incremental higher drag that we are seeing from the exports to US, 12% decline in September, more than 12% decline in September, assuming a similar trend in the remaining Q3 because majority of Q3 is done and we still have 50% bilateral tariffs. But at the same time, in Q3, the GDP deflator, which is under like a lot of discussion on it, but that support becomes even more pronounced for us. GDP deflator turns negative in Q3 because WPI inflation becomes negative. CPI is at sub 1% for the quarter. That will again boost your real growth. In terms of quality of pickup, urban has responded to the GST cuts. For example, you look at the consumer durable loans. This is again based on anecdotal. You look at the commentary from banks and NBFCs. We may not have seen a very sharp pickup in credit card transactions in response to GST, but I have a feeling that has actually gone into consumer durable loans, which have picked up much more stronger in response. Also, if you look at the fact that rural should continue doing better in Q3. So Q3 will get the support of urban, rural. The drag on Q3 is going to be the capex side. For example, the government capital expenditure that is slowing down a bit. For instance, you look at state government, already the capital expenditure growth has slowed to 0.3% in Q2. And for center, it's still pretty strong in Q2. H2 will be a real challenge for governments, both center and states, because they're facing quite a significant slowdown in revenue collections. Partly the center gave us income tax cut. Also, we've got a GST cut which will hit both the center and states. We will see more of that impact in H2 because it's effective September 22nd. So you will see a slowdown in capital expenditure. So taking all of that, we are still retaining a very conservative 6.8 without a trade deal. But I honestly will not be surprised if we hit 7% even without a trade deal because there are a lot of these one-offs that are also playing out. For example, the GDP deflator is there. Rural pickup has been pretty significant. We're still not seeing any negative impact on rural demand from the sharp decline in food prices. Also, the fact that the services side, yes, trade deficit has widened, but the services side, because our services surplus is almost, let's say, between somewhere around 15 to $20 billion per month, it is, I would say, moderating some of that widening in trade deficit. And the widening in trade deficit, to a large extent, is still due to gold imports. If you look at non-gold trade deficit, it is a very moderate pickup. And and the pickup in gold imports, that is mainly a price impact. Volume of gold imports have not picked up so much. So a lot of people are making this the case that the pickup in gold imports will drag real growth. That will not happen because it's a price effect. It may drag nominal, but it will not drag real because the quantum of gold imports that has gone up slightly. So I would be pretty, I mean, full year FY26, we are tracking at a 6.8 on a very conservative side. I will not be surprised if we can hit full year at around 7%. The key thing is for urban, to answer your question, will it sustain? The key thing is we need to see urban wage growth pick up. That is the ultimate test of sustainability. And that's why Q2 results, we'll wait for the RBI data to come out for their assessment on labor expenditure by listed companies. That's our proxy for urban wages. But from what I can see, overall expenditure growth in Q2 picked up. So I'm a bit hopeful that maybe urban wage growth could show some pickup in Q2, Q3 onwards. Then only will you have a sustainability in terms of urban demand. For now, our 6.8 is building in some moderation in Q4 from the urban side.
Rumki, coming back to you, is 7% growth possible? Two, what would be the drivers for it? And what are the pitfalls if you see that can happen leading to that 7% growth?
Got it. Hi, Ishan. Thank you so much. So I think second quarter projection has been a little difficult for us because it can go either way. One, many of the pointers that Gaura did mention, the only catch is when did the consumer spend? Because on 15th of August, the Prime Minister announced about the GST. And usually Indian consumers tend to spend a lot more during festivities. So there's a possibility that a lot of consumption spending got pushed out after 22nd of September. So if that would have happened, a lot we will see a huge sharp rise in consumption from 22nd of September and spilling over to October and November because of Diwali and subsequent expenses. So it's possible that the Q2 consumption spending may not be as big. But if suppose between 22nd and 30th, the consumption has been very high, it might show up in Q2 as well. For sure, Q3 consumption will be very, very strong because of the Diwali expenses, spending due to GST during Diwali time. So that will be a deciding factor on whether Q2 will go above 7% or below. Of course, government capex have been very strong in the first half of the year because last year the capex spending was much lower because of the elections time. So this year you will see capex already 51%. So clearly, government capex will pick up. We were looking at the profit of corporates, the Q2 corporate, because all the earnings have been announced and Q2 has done well. Clearly, the EBITDA margins, all these numbers were quite strong that way. Clearly, and they pointed to some very strong growth in the rural consumption. So Q2 will be mostly driven by government capex. If consumption, then mostly in the rural segment. And in the Q3, we are expecting a big jump in Q3 because of the GST factor, because a large amount of spending will get concentrated in these couple of months. So Q2, we are expecting around, if consumption moves either way, 6.5% to 7% is what our Q2. We are much more optimistic about Q3 because that's a festive time, October, as well as year-end time. And so it could be even higher in the Q3. So most likely, some of the growth momentum will spill over into the second half of the year as well. It's the fourth quarter, which will probably be a little modest. So if 3 quarters are around 7% on an average, I think this year we will definitely cross 7.1, 7.2 mark by easily for the fiscal year. That's what we are expecting.
Gaura, two questions before we let you go. One question is regarding the GST consumption boost. Is it expected to hold beyond the festive season? Because a lot of people are saying that it might be softening coming forth, especially on the urban side, as you mentioned as well. The second aspect of it is that can the government capex continue at the same pace, given that there are constraints, especially on the revenue side, and we are looking at net tax collections going not being as strong as they were last year?
So definitely that is the main the main success yardstick for GST will be whether the consumption sustains into Q4. That will be a function of wage growth. If urban wages, if you let's say if your wage growth is growing, employment conditions are picking up, you will be more comfortable to spend or definitely there'll be some moderation in expenditure because as Rumki said, there was a bunching up of expenditure that happened in Q3. Some part was delayed expenditure pushed because the GST cuts were announced in August 15th. So some part of the expenditure got pushed out to September 22nd onwards, plus you had the normal festival season. So I think our expectation is there should be some moderation, but it may not be that weak. What we are seeing and what commentary we are seeing also from, let's say, the banking system is that the exuberance on the consumer oriented loans that picked up in Q3 seems of during the festival season seems to be maybe not at the same pace, but it's still higher than what is usually seen. So it looks like some part of that recovery is still holding up beyond the festival season. But the real factor that will make sure that you'll have a sustainable pickup in urban is going to be wage growth. The other part is household savings. So the other constraint that urban is facing is not just the slowdown in wage growth, is also the fact that savings overall are, as a proportion of GDP, have reduced to pre-COVID level or below pre-COVID levels, and this is because that buffer that we've all saved up during COVID, that has been largely spent. So you saw that post-COVID, there was this couple of years where urban really picked up. You've seen pick up in the car sector did really well. The real estate sector also started to pick up. Now we are at a pace where savings is back below pre-COVID levels as a proportion of GDP. So both these, in such a situation, it's very important for the wage growth, the employment generation in the urban side to pick up. And that's why what I liked about Q2 listed company earnings is that this, for the first time, I would say, sales growth has shown a pickup. In FY25, a large part of the growth rate in the profits was a margin story. Q1 was also a margin story. Q2 was the first time that you're actually seeing the revenue side pick up, which is a good sign for domestic demand. So as company revenue growth picks up, they will tend to also pass it on to their employees, and you will see a pickup in urban. So my short answer is there are some hopeful signs, but we'll need to see a pickup in wage growth on the urban side for the boost that GST has effectively given to sustain. And you're talking about government capex. There is a challenge. You have nominal GDP growth for us is tracking for the year at 7.5. The good part is the union budget was very far-sighted. They kind of budgeted an 8% growth. But if you look at the revenue assumptions on the income tax side, it was very optimistic. Even after taking into account the effective loss in revenue due to the income tax cut of around 1 trillion plus, the assumption of growth rate was very optimistic, and we are seeing there will be an easy shortfall of around 1.5 trillion rupees on a net basis on tax collections. Even indirect tax collections, for example, GST, the first month post the cut, it was the October collections, but this was October, the revenue collected in October for transactions that happened in September. Their growth rate slowed down to around 4.5 from the usual sub 10, around 9% for the previous months. As we get deeper into FY26, the second half, further slowdown is expected. State governments, we are also seeing quite a slowdown in terms of both their own tax collections, which are usually indirect taxes, and also because the center is facing a challenge in revenue collections, what it's able to share with states, that is also seeing a slowdown. So definitely there will be some moderation in terms of expenditure on capex. For the center, I think the moderation is less. For states, they will have to moderate quite a bit to ensure that the fiscal slippage risk is minimized. So yes, our H2 builds in moderation in capex led by state governments.
Thanks, Gaura. Thanks for coming on the show. We would love to have you back again. Rumki, stay with us. We have a few more questions with you as Ranen joins us. Thank you, Gaura. Rumki, one of the things that Gaura was talking about was capex from the government side not being as strong enough. There's a problem on the private capex side as well, and you've been working with a lot of in the private sector. What's the problem there, and can it be resolved sans a US deal, or do the geopolitical environments need to improve in order for that to be resolved?
So I think both will play a factor. One, geopolitics will keep weighing on private capex. Until private capex pick up, I think the government will keep pushing its spending to build on infrastructure and other asset building expenses. And that's the Keynesian theory. So it's a simple theory of where if private sector is not kind of taking the burden of bringing in investments, the government jumps in. That said, of course, the government has its own limitations. It has only limited resources with which it can work with. So it's time that the private capex picks up. And to be honest, now that the consumption is kind of showing up a quick revival and a sustainable one, because Q2 is expected to be more or less strong, and Q3 is obviously off the chart. If you look at the sales numbers, many of those, the sales in two-wheelers, electronics is pretty much off the chart. So clearly, this could be an indication for the private sector to come in and spend and invest in rather invest and build their capacity utilization, because that is something which we are already closing to its peak. So it's matter of time that capex picks up, and if suppose US India deals comes through, which anyways the government is hinting at, and it might be maybe a few weeks away, then it will reinforce the sentiments, and definitely it will bring in a lot of capex spending. But that said, I think the government has also done a fantastic job of diversifying our trade. We have also looked at other alternative destinations to trade with. So clearly, there is an effort that if trade uncertainty from the West is weighing on us, we also make sure we look into other geographies to build that momentum, and that will probably work in our favor, and probably help us bring in more investments from the private sector.
I think we have also with us Ranen Banerjee, partner and leader economic advisory services at PwC India. Thanks for coming on the show, Ranen. Can you hear me?
I can. Yeah.
Perfect.
I
So,
can.
Ranen, we
Thank
were
you.
talking about the return of private capex while government capex slows down. What is your assessment? Can capex return to, in the absence of a trade deal, how much of a hit is the economy expected to take in Q4?
So I think see the in the absence of trade deal, and that's a big assumption that we are making. But what has happened is that if you look at the U.S. The reduction in the exports to U.S., we have actually our exporters, and as we know that the trade is quite versatile, we have been able to find other geographies to export because the growth has expanded. What happens is that if you look at the total production across all the countries which are exporting to US, now the production capacities cannot be suddenly added in geographies which kind of fills in the gap that happens because of the lesser exports from India. So therefore, it kind of creates a space in other geographies. Like if the exports go a little higher to from some of the geographies to US, then it creates a little bit of a space for Indian exports to those geographies, to the other geographies. So and that has been kind of seen through the increase in exports that we have seen in other geographies. But obviously, if the global headwind continues and the economies in outside US as well as US continue to demonstrate weaker growth, then it is going to have an impact on the exports for sure. And that, of course, puts a little bit of a doubt in the minds of the Indian manufacturers. And when there is doubt about demand and the continuity of demand, then capacity addition will not be undertaken, or all the decisions will be postponed. Therefore, expecting a private capex suddenly to pick up in Q4 is possibly not going to happen, and we'll have to wait till we get more clear signals of demand and demand resilience, and maybe more clarity on the trade deal as to how it progresses before private capex kicks in.
Rumki, US trade deal has become a case of if tomorrow happens, when tomorrow happens, or tomorrow may never come, one of those scenarios. But let's say the deal does happen, what kind of a growth push are we looking at? And you were saying 7.1, 7.2% growth is also possible. Can we go higher on the full year number if the US trade deal happens in that sense?
I'm absolutely optimistic that the number could be much, much higher than what we're expecting. I mean, the Indian economy has always surprised us on the positive side, especially when the expectations and the confidence is low. So clearly, Indian economy has that resilience, and we have seen over time that domestic demand has been able to hold up despite the global uncertainty. And the government is doing its bit. I mean, it's bringing in reforms one after the other, given the challenging situation. Be it the tax exemption, which has been one in a like many decades that India has ever seen. GST reform, which has been pending and been a request and had been on the list for a long time. They brought this in. Labor codes, one of the difficult reforms which were announced about 5-6 years back, and now the government has stepped up its efforts to make sure that happens. So clearly, the government is also making an effort to improve consumption spending, give the right boost. Of course, monetary policy also is included, and also the supply side is also it is addressing, because that so far has led to a lot of challenges in inflation, and that is something now that it is under control. But we would like to ensure that inflation remains under control. Earlier, it was a supply side problem, and that's why the government is also working towards improving, diversifying its geography, improving its trade, trying to bring down its cost of production, making through infrastructure, through labor expenses. So resource costs that are also being brought under control. So all these factors, so the government is working both on the demand side and the supply side to ensure that inflation doesn't come back up again. And if as long as inflation is low, as long as domestic demand remains strong, I think that will help the real GDP growth very strong. Nominal GDP, of course, remains questionable, because again, we did discuss earlier, the deflator will result in the nominal GDP to be lower, which is not good in a way, because all the percentages are calculated using nominal, be it fiscal deficit or debt or any other current account. But that said, the efforts are there, and I think it's also materializing on the economy front. So I'm very optimistic about this year, fiscal year, and I won't be surprised if the growth for the fiscal year goes above 7.5 as well.
Ranen, one of the things that we have been discussing, and one of the problems besides the inflation aspect, is the urban consumption story. Now, household debt is high, right? And you see some stress in household. Wage growth has not happened as the way that we expected it to. And AI is keeping some of the services away. If you look at IT, there have been job losses in certain sectors. Within that paradigm, do you see urban consumption going strong, especially usually when we see that there's a tendency to save among households whenever the goings get tough?
So I think, see, I believe that urban consumption should hold up, and this is primarily because the thing that it will flow from is what we have seen. There are two aspects that have happened. One is the income tax exemptions towards the lower end of the spectrum in the salaried, amongst the salaried, that is going to help. And second, of course, is the GST rate rationalization. Now, clearly, these two in a way puts more disposable income in a larger number of households in the urban areas, which has a higher proportion of organized labor. So therefore, I think these are factors that are going to help in the urban consumption. There is also a kind of a trend that we are seeing, that while, yes, household debt may have been a little higher, and there was a stress being felt, but as disposable incomes increased, owing to the tax reduction in tax, as well as both on the indirect and direct front, I think most of that delta in the households will be consumed, and it would not go towards saving, because the marginal propensity to consume is higher at the lower end of the spectrum of the households. So I believe that we should be having a good urban consumption trend, and the initial numbers that we are seeing is quite visible. If you look at there has been a revival in the smaller segment. See, if we take one data point of auto, now the smaller car segment was struggling, but we have now seen that segment of the sale has also picked up, which is an indicator that the consumption is going to get a positive boost. So I believe that urban consumption should also be printing, if not very strong, but strong.
So, Ranen, what is your estimate for the second half of the year and for the full year FY26?
I think second half of the year will clearly be much higher than the first half, because of the one is that the GST related cuts that happened, and also some of the consumption, at least in the last month of the quarter, got postponed to the second half. The second quarter got postponed into Q3. Therefore, I think if in the second half, clearly the growth would be above 7%. And it is also aided by the fact that what Rumki mentioned, the deflator, because what's happening is that our WPI is almost zero or even trending towards negative. And some of the items like government consumption, etc., it is first calculated nominally and then deflated. So that is the deflation is going to be lesser in those aspects, and therefore kind of a statistical boost will also be there. And therefore, it is going to be 7% plus in the second half for sure. And I think full year, I believe that it will be anywhere in the range of, it will for sure be possibly 6.5 or slightly more than that. So that's where we are likely to land.
Rumki, can we go to 8 also, because there's a revision that's coming in on February 27th, new numbers that will be released, the new series that will be released will have a lot many more indicators. I was just reading the discussion paper. They have expanded the base of companies that they're tracking, active universe, LLPs and everything. So we saw a boost last time around also when this revision happened. Can we expect something similar as well?
Most likely, I'm inherently optimistic about Indian economy, so I would not be surprised if it is. And I have reasons to believe, because since 2011-12, we have seen a huge dramatic shift in the manufacturing sector and the kind of services that we are providing. And these are all high value add manufacturing and services. Right. In case of manufacturing, we have seen the role of electronics, electrical goods, heavy machinery. They are contributing a lot to the value add of manufacturing. And similarly, services, the GCC's role in delivering much higher value add services has gone up. So if these are brought into the basket of estimation, and their weightages will also increase, it will definitely show up in the growth numbers as well. So very likely that the numbers will be revised up.
Ranen, coming to you, if the US trade deal does happen, right, and India does get favorable terms, either comparable or below what the rates have been to Asian economies, how much of a boost do you see this year, and how much would it actually affect next year? Or would this year just pass by and we'll see most of this in next year?
So it will be most of it will be passed by, because as we saw that when the tariffs were announced, means there was a bit of a front loading, etc. So supply chains adjust a little bit. So when we get the trade deal, is for sure, means it will happen. If it happens, it will happen in the Q4. And by the time the effects come in, it will most likely the year will be over, the fiscal year will be over, and therefore majority of the positive impact will come next year. But yes, Miss, there will surely be a kind of a leg up, a small leg up towards the end of the year, maybe the last 2 months of this fiscal. So yes, maybe a kind of a 10 basis point leg up this year, but clearly about 50 basis point leg up next year we can expect from that.
Ranen, it's a bit early to ask, but the government has delivered on the labor reform side. You've seen the GST cuts happen, you've seen rationalization, more than the cuts, the rationalization happen, income tax cuts have happened. What is the next agenda on reform, and what would you want to see in the budget going forward in terms of reforms that can be done, especially with respect to getting industry to invest again?
See, I think the key thing for industry, I think, would be some of the things are more operational on the ground at the state level, and I think the labor codes have been done, and there are certain floors that have been fixed, etc. Right, but at the end of the day, it will be implemented at the state level where actually the investments take place on the ground. So continuing with the business reform action plan that was launched, and ease of or more simplification of the compliances is something on which, if there can be incentives, which there can be real budget allocations for giving incentives to states which move faster on the adoption of the reforms, on the factor reforms, which is the land and labor. So any movement on that at the state level and incentivizing those states with real money is something that could possibly help in attracting more investments in the states, because investments will happen in the states. Center can only set certain guidance and guidelines and nudge the states. And how you may incentivize states to pick it up is, see, we were doing rankings, and rankings were like a soft messaging to the various investors to come to a particular state, but all the states were matching each other. Now, if there is an incentive to implement some of these reforms on the ground at the state level, and there's money set aside in the budget, that is going to help significantly. So therefore, if a scheme is launched, like there was a kind of a capital
Yeah.
the loans that were given incentive led, like that, it will be kind of a ease of doing business led incentives for states, which the states can draw upon if they meet certain conditions, is something that may spur investment, and the government could
Rumki,
consider
any
that.
budget wish list from the government or reform wish list from the government as far as land or land reforms are concerned? Because that has been a one big one that has not happened till now, especially on the state side at least.
Right. So land reforms, I think those measures will continue because it's not a very easy reform to bring in with so many states and so much complications involved. With where I would expect the government to now push the effort is towards MSMEs, because they hold a very, very important role in terms of creating jobs, creating income, creating and given that we are seeing so much of uncertainties in exports, I think MSMEs, which account for almost like a large proportion of exports in manufacturing, they need to be supported. And of course, given their importance, they need to be given access to credit, given access to infrastructure, technology, because the adoption especially AI in MSMEs is very, very poor. So clearly, these factors have to be brought in. We need to improve the productivity of MSMEs. And this is a study we have been doing lately. We published a report last month on MSMEs, and we're kind of coming up with a subsequent report. And we find capital and labor productivity in MSME sector has been really, really weak. And that is where the effort has to go. And I think that will be my wish list, is because that's a segment that needs a big push.
Ranen, last question to you. On the RBI side, do you believe there is more room for rate cuts, and especially in the December meeting? And can we go below 5.25% as well, or is that the floor that will hit?
See, I believe that room, of course, is there. The headroom is there to do rate cuts because of the softening inflation, though we know that food inflation has come down, and that has contributed mostly to the inflation, the benign inflation that we are facing, and it can reverse at any time owing to some weather events, etc. As we have seen in the recent times, the tomato prices were shot up, right? So that there will be volatility, and the core inflation also like has been holding up, but it has been holding up around 4%, which is the target rate. Therefore, from a headroom perspective, I think the RBI or the Monetary Policy Committee has headroom to do the rate cut. The issue is, when do you fire this bullet? Now, if we are saying that the growth rate, and as Rumki said, and I also believe that the growth rate is going to be good in this fiscal, and is there an urgency to give a monetary policy boost by doing the rate cut? Because I believe that even the past rate cuts, the full transmission has still not happened. So even if the rate cut is done, the transmission takes a little lag. Therefore, I believe that some members of the Monetary Policy Committee would really dwell upon when to fire that bullet. Headroom is there, but do you fire it too early or at the right time, and whether this is the right time? Because if the growth is continuing, then do we need to give another boost, or we wait to see how the Fed behaves, what is the kind of events that take place globally? So I would not be surprised if the MPC actually does not do a rate cut in the next policy meeting also, though headroom is there.
Got it. Thank you. Thanks for coming on the show, Ranen. Thanks for coming on the show, Rumki. The big takeaway here are Q3 is expected to be better, urban consumption will hold up. You can see 8% plus growth rates as well going by the end of the year, but 7% is possible according to Rumki. Ranen is saying that the growth would be somewhere around 6.5 to 7%. If a US deal works, the effects of it would be visible from next year, and they would be positive, of course. One of the interesting aspects that Ranen pointed to was the ease of doing business linked reforms that can come in, that can help in terms of ease of doing business linked loans that the government can give, like it was giving capital loans, and that can also help. Rumki's budget wish list was on MSMEs. We would love to have both of you again on the show again. For the viewers, thank you for watching. We'll be back again next week with more news and analysis. Thank you. Thanks, Ranen.